I have a feeling it's going to be at a lot higher prices, both for gold and the Dow, because I see a hyperinflation and a melt up in the stock market, and gold is going to follow and it's going to outperform. But it's difficult to say at what prices they would cross. It could be 50,000 each, so it would be 1-to-1, or it could be gold. If we could see, let's say, a melt up continue, gold doesn't catch up with the Dow, and then you see a collapse, let's say in the stock market, but gold stays pretty steady, let's say at 10, 15,000, but then the Dow drops to 15,000 as well.
Investors have been climbing the proverbial wall of worry to new record highs on the stock market this year, fearful with each step that the market is about to have a reversal. Meanwhile, gold's move to record highs has been far more impressive, and buyers seem to have no worry that the end of their rally is in sight. The Dow-to-Gold ratio isn't just a number, it's a warning. Right now, it's telling us a story of extremes. Financial analyst Mario Innecco warns that the ratio to hit parity, either in a hyperinflationary surge or if stocks crash while gold holds around $10,000. In either case, gold comes out ahead. Mario Innecco emphasizes the trend since 1999 is clear. The Dow-to-Gold ratio has been sliding. This indicates a gradual yet steady shift away from paper assets and toward gold as the ultimate measure of real wealth. Looking at recent history, the ratio peaked in 2019. At that time, one Dow Jones share cost 20.5 ounces of gold. Today, it has fallen to 13.5, above the historical median level. Over the past few years, the ratio has fallen sharply due to the rapid rise in gold prices. He calls for a slow-motion reset, not a sudden policy shock. In gold terms, the Dow and S&P have been losing real value since 2000, and he expects that slide to continue. For him, gold's steady performance since 1999 proves it's the safest store of value. Revaluing US gold could hand the Treasury a substantial windfall and establish a higher floor for prices, much like in the 1970s. Innecco says such a move could shake markets, which is why he urges holding gold early rather than scrambling after the fact. While the current monetary system differs significantly from the gold standard era, the underlying principle remains relevant. Revaluing gold reserves can strengthen a nation's balance sheet and provide greater stability during economic uncertainty. Before we dive into Mario Innecco's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, the Dow-Gold ratio, if you go back over 100 years and into the 1920s when there was the stock market bubble that burst in 29, that ratio topped back then around 20, and then it dropped to 2, I think. And then it took another 32 years for it to go up again. In 1966, 67, it went up to 26. And then it dropped to 1 in 1980, and then it rose again to the mid-40s by the end of 1999. And the reason why I say the reset has been ongoing since then is because what the Dow-Gold ratio reveals, in my opinion, is the preference for gold or real money versus paper assets. And that's what it really implies. The fact that it's been going down since then, of course it hasn't been going down in a straight line, says that more and more confidence is being lost in financialization and paper assets. And the gold is the premier, let's say, indicator of hard assets and real things. So that's what I think it's implying. And I think, a reset is a correction. So if we price stock market in terms of the Dow, even the S&P in gold since the beginning of the century, they've actually been losing real value, and I think they're going to continue to do so. And unlike, let's say, an overnight reset, which happens when governments and central banks adopt a policy, let's say, over a weekend, the reset I'm talking about is more gradual, of course. And a lot of people have lost out, in my opinion, because they've been in paper assets. And I'm not saying they haven't done well, but I think being in gold is very safe, and it's done a really good job since 1999. I have a feeling it's going to be at a lot higher prices, both for gold and the Dow, because I see a hyperinflation and a melt up in the stock market, and gold is going to follow and it's going to outperform. But it's difficult to say at what prices they would cross. It could be 50,000 each, so it would be 1 to 1, or it could be gold. If we could see, let's say, a melt up continue, gold doesn't catch up with the Dow, and then you see a collapse, let's say in the stock market, but gold stays pretty steady, let's say at 10, 15,000, but then the Dow drops to 15,000 as well. Or, yeah, there's all kinds of repercussions. But one thing that I think the Dow Gold ratio indicates is that when it's near 1, that means that it's probably a good time to get back into financial assets, actually. So, not saying you should get out of all your gold, because gold, in my opinion, and silver to some extent, they're all like saving instruments. So all that gold and the certificates at the Federal Reserve are worth about $11 billion. So if they revalued the gold certificates to, let's say, $3,400, that would be that would be about 800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at 3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was, so that's about four times, so it's about 4 trillion. If you do it to 30,000, that's 8 trillion. So they could choose any number. But the thing is about revaluing, and we saw the other day, Alexei, that even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. So are they preparing to do a revaluation? I don't know. It's just speculation. But if they revalued it to the market price right now, let's say 3,400, yes, they'd have an extra 800 billion, the Treasury. That would help them. But what it would do, it would put a floor under the gold price. Because back in 73, when they revalued it to 42.22, we never saw that price again. And by 1980, the price of gold had gone up to like almost 900. So it would be, even if they revalued it to 3,000, for example, it would be very bullish. They might want to do it a little more than the current market price, maybe because they might want more profits for the Treasury. They might just let the market keep going higher, and then maybe in 6 months to a year announce it, let's say at 4,500. Or they could announce it over the weekend at 10,000, and that would basically close down the gold and silver market probably for a week, because things would just go crazy. I don't know what would happen, and that's why I tell people it's better to be early than one day late. And that's why I say, you need a little bit of physical gold and silver.
The current bull run for precious metals will be similar in scope to the 1970s as the world continues to face stagflation. The world's debt burden has risen above World War II levels, and deteriorating budgets mean that debt relief is likely to be achieved through currency dilution. The Treasury is quietly issuing more short-term debt, even buying back longer-term bonds, essentially doing yield curve control. Mario Innecco underscores that a major gold revaluation could enable them to buy most of the Fed's assets, reset its balance sheet, but only after a painful period that primarily hurts everyone except the wealthy. On August 1st, the Federal Reserve published a research note called Official Reserve Revaluations, the International Experience. It outlines how 5 countries used gains on their official gold holdings to raise funds. It does not propose that the US do the same, but it explains the steps involved and what to expect if such a scenario were to occur. However, Mario Innecco points out that for centuries, gold's rise was slow. Rulers chipped away at its value bit by bit. Before World War I, nations returned to the gold standard after wars to curb inflation, a discipline now lost, making today's paper and digital money far more prone to rapid devaluation. Let's get back to the interview.
What the Treasury is doing is something very technical, so that won't even see the light of day in the mainstream news for the general public. So what they're doing is they are issuing more short-term debt, so that there's not that much pressure on the longer-term interest rates. So they're doing actually what Janet Yellen was doing, and they were critical of Janet Yellen. The other thing they're doing, I saw that they can buy back like existing debt, long-term debt. When they issue short-term debt and they get the cash, they can go in and buy 5 and 10 years debt. And I think they're doing that. Actually, they announced it a couple of weeks ago, the Treasury. So that's how they do it, because right now the Federal Reserve is still doing quantitative tightening. They're still selling their treasuries or letting them roll off without adding them back on. So yeah, they can do it, and they can kind of do yield curve control, which is usually the something the central bank does. So the other thing with a possible revaluation, let's say if they revalue to a level where they got, let's say, around 6 trillion or maybe a little less, they could actually go to the Federal Reserve and buy all their almost all their assets, because the Fed's balance sheet is like just under 7 trillion. That they could go and buy 6 trillion worth of it and retire all that debt, treasury debt and mortgage debt. And then the Fed's balance sheet would go back down to like 800 billion, which was where it was before the '08 crisis. And then they can start inflating the credit system again. Maybe that will happen once we get that 1-to-1 Dow-Gold ratio. That would make sense, because from then they can start again. It's going to be another 30, 40 years maybe of boom. But before that, it's going to be painful. And it's already painful, I think, for the majority of people. It's only the people at the top and the very wealthy that are benefiting right now, because asset prices are going up and they have a lot of assets. I use the term in the millennium, I guess, 1,000 years, because I looked at this chart from Gold Charts R Us, and they had gold, the gold price since the 1200s. And it goes steadily up, which means the nations or the kings and queens, they debase the gold, through wars and stuff. But then you look at the 20th century and World War I, World War II, and especially after 1971, and the price of gold is like a hockey stick, and something that never happened before. And that's the situation we're in, because prior to, let's say, World War I, when there were major wars, for example, the Napoleonic Wars, there was inflation here in the UK, because they suspended convertibility of the banknotes into gold. But after the war ended, they went back to gold standard. You could redeem the gold. And actually, there was zero CPI growth up until 1914. The real debt went down in the UK. So that's what they used to do after the wars. They used to come to their senses and pay a lot of it off. But ever since World War I, they haven't gone back. They tried, I guess, during the 1920s here in Europe, and by the early 30s, it didn't work. And I think the reason it didn't work was that World War I was such a horrific and major war that, they completely bankrupted all the major nations in Europe, and it was really difficult to get back up from that. And And then in 1971, it got really bad because we detached, currency from real money, i.e. gold, for the first time since ever, I would say. And during the Roman period, they didn't have paper money. They didn't have banknotes. So the way they devalued the currency was through debasing the coins. And that took about 100, 200 years. But I think by the end of the third century, and especially in the fourth century AD, the silver denarius had almost no silver. So that's how they used to do it. In the beginning, it worked, but then, the soldiers and the people that got paid with that, they realized that, oh, we got half the silver in this coin, so prices doubled. That's how it used to happen. But now it can happen really quickly because we use now digital entries and paper.
Leading financial institutions have recently revised their gold price projections upward, reflecting growing confidence in gold's prospects for late 2025 and beyond. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. When the next reset comes, will you already be holding gold, or will you be trying to catch up after the fact? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.